Next, let's move on to stocks news updates and let us break down each of them in a clear and very understandable way. First, let's talk about Reliance Industries. Reliance Industries Limited Q2 FY 2024-25 results has been published, and I'll make sure you understand the key takeaways from Reliance Industries' latest earnings report. Reliance Industries Limited, or RIL, is one of India's largest conglomerates. Their quarterly results are always highly anticipated. So let's dive in. Reliance Industries Q2 FY 2024-2025 revenue stood at 2.35 lakh crore, largely in line with the previous quarter. Net profit increased by 9.4% to 16,563 crore. Now, let's look at Reliance Industries Oil to Chemical segment. Revenue grew 5.1% to 1.56 lakh crore, driven by higher volumes and domestic placement of products. However, EBITDA declined 23.7% to 12,413 crore due to unfavorable demand-supply dynamics and lower margin. Next, Reliance Jio Platforms. RIL's digital services arm delivered a stellar performance this time as well. Profit increased 23.4% to 6,536 crore, driven by strong subscriber additions and tariff hikes. Jio average revenue per user, or ARPU, improved 7.4% to 195.1 rupee. Reliance Retail Ventures reported a 20% increase in net profit to 2,935 crore, driven by strong sales in premium formats and hyper-local deliveries. The company's focus on omni-channel retail is paying off. Looking ahead, RIL's management expects oil demand growth to be slow globally. However, India's demand is expected to pick up during the festival season. The company is optimistic about its future growth prospects, driven by Jio's 5G expansion and Reliance Retail's growing footprint. Reliance shares fell nearly 1% after the Q2 results as investors digested the soft numbers. Brokerages have revised their target prices, with MOFSL cutting its target to around 3,255 and HDFC Institutional Equities retaining its target at 3,350, whereas Nuvama suggests a target price of 3,650 and huge new energy prospects. MOFSL sees Reliance Jio as the biggest driver of EBITDA growth over FY 24 to FY 27. Antique Stockbroking cut its FY 25, FY 26 and FY 27 EBITDA estimates for Reliance due to weaker retail and oil to chemical performance. HDFC Institutional Equities retained its target price, while Nuvama is bullish on new energy prospects. Reliance Q2 FY 2024-25 results demonstrates company's resilience and growth potential. Jio's strong performance and Reliance Retail's expansion are driving growth. So if you have any questions regarding this, don't forget to comment in the comments below. I will try to answer them. Next, let's discuss HCLTech's results, which was also released yesterday along with Reliance. HCL's impressive Q2 FY 2025 results and the subsequent target price upgrades from top brokerages. And I'll also break down the key takeaways for you. HCLTech delivered a strong, broad-based growth across verticals with engineering and research development services, HCL software and IT and business services growing 1.1%, 1.4% and 1.8% subsequently. Consolidated net profit stood at 4,235 crore, exceeding estimates. HCLTech upgraded its FY 2025 revenue growth guidance to 3.5 to 5% from 3 to 5% earlier. So this is a very good update. This positive revision is driven by strong growth demand and recent deal wins. Top brokerages have upgraded their target prices on HCL. Nuvama raised its target to 2,125 rupees, citing HCL's sharp re-rating driven by higher growth and improved capital allocation. Antique Stockbroking increased its target to 2,000, while Centurion Broking maintained an ad rating with a target of 1,994. Despite the positive outlook, HCL management remains cautious due to macro and geopolitical uncertainty. Wage hikes will also impact operating margins H2 FY 2025. Strong demand and recent deal wins drive the revenue growth guidance. So try to keep an eye on HCLTech's progress. Next, let's talk about Hyundai. Hyundai India's mega IPO set to open on October 15th today. Hyundai IPO will open for public subscription on October 15th and closes on. The price band is set at 1,865 to 1,960 per share, with the issue valued at 27,870 crore. This will be the largest IPO in Indian history, surpassing LIC's 21,000. Hyundai India is a leading automobile player, holding a 15% market share in the domestic passenger vehicle segment. The company manufactures parts including transmissions and engines, and is India's second largest exporter of passenger vehicles. Most brokerage houses have tagged subscribe rating to the IPO, citing steady growth prospects, robust financials, and a healthy SUV product state. ICICI Securities expects limited listing gains but healthy double-digit portfolio returns on the medium to long term. However, risks include rising competition, potential slowdown in the domestic passenger vehicle industry, and seasonality impact as well. Investors should consider these factors before subscribing to the issue. At the upper price band of 1960, Hyundai India is valued at 23.6 times FY24 earnings per share. The company's strong brand, blockbuster models, and advanced technology, along with high export potential, are key differentiators from their competitors. Hyundai India's IPO offers a unique opportunity to invest in a leading automobile player. Consider the analysis and make informed decision. Try to do even more research before making any decision. Next, let's talk about Nvidia's remarkable surge, surpassing Microsoft to become second most valued company globally. Nvidia's market value has reached $3.39 trillion, trailing only Apple's $3.52 trillion. This achievement is driven by investor optimism over strong demand for Nvidia's AI artificial intelligence, particularly in the data center and cloud computing segment. The AI sector is experiencing rapid growth, with major tech firms competing for dominance. Nvidia's strong position in scape is fueled by its advanced AI chip designs and also partnership with industry leaders and strategic investments in AI research and development. TD Cowen analysts have reiterated their target price for Nvidia at $165 per share, labeling it as the top pick. TD Cowen is a research firm that provides investment analysis and recommendation to institutional investors and financial institutions, and they are telling Nvidia as the top pick. They highlight Nvidia's strong demand for current and next generation AI chips despite production delays for its Blackwell chips. Nvidia rise has significant implications for the tech industry. The company's dominance in AI chips forcing competitors to invest heavily to keep pace. This prisoner's dilemma scenario benefits Nvidia as it solidifies its market position. Nvidia, Apple, and Microsoft make up about a fifth of the S&P 500's weightage, influencing the index performance, like how HDFC Bank, Reliance Industries will influence Nifty's movement here, being heavyweights in the index. So, the Apple, Nvidia, and Microsoft trio's collective gains contributed to the S&P 500's record high, with Nvidia stock rising 2.4% to $138.07 per share. So, what can we learn from Nvidia's great rise? Firstly, innovation is key. Nvidia's investment in AI research and development has paid off, establishing the company as a leader in the field. Secondly, strategic partnerships are crucial. Nvidia's collaboration with industry leaders have expanded its reach and solidified its market position. Thirdly, diversification is essential. Nvidia's expansion into new markets such as data centers and cloud computing has reduced its dependence on the gaming industry alone. Fourthly, competitive advantage is very important. Nvidia's advanced AI chip designs have created a significant barrier to entry for competitors. Lastly, investors' confidence. Nvidia's strong financial performance and growth prospects have attracted investors' confidence, driving its market value. Additionally, Nvidia's success highlights the importance of adaptability, visionary leadership, and long-term thinking. By embracing these principles, companies can position themselves for similar success in their respective industries. As the competition heats up, Nvidia's dominance will be fascinating to watch out. Next, let's talk about reasons behind JSW Infra's impressive rally. Driven by Nuvama's buy call today, JSW Infra shares have rallied 53% since the start of the year, with a 3% gain today to reach 329 rupees per share. I don't know where the price closed today, but when I was looking, it was up by more than 3%, driven by Nuvama's buy call and 390 target price given by them. This represents a 22% upside potential from the previous day close. Nuvama cites JSW Infra strong parentage, robust growth in the third-party cargo, and evolution into full-fledged logistic utility company. The brokerage firm expects JSW Infra to maintain its head position as the second largest private port operator in the country. JSW Infra growth is driven by its strong relationship with the group companies, including JSW Steel and JSW, long-term contracts with take or pay provisions, expansion into logistics and cargo hand, and robust financial performance. JSW Group's ambitious plans will drive JSW Infra's growth. At JSW Steel, the group company, targets 50 million tons production capacity by FY31. JSW Energy aims for 10 gigawatt by FY25 and 20 gigawatt by FY30. This expansion plan will increase cargo volumes and revenue visibility for JSW Infra. The investment thesis for JSW Infra is built on strong parentage and group relationship, robust growth prospects, evolution into a fully logistical utility company, and attractive valuation. So the Nova's Vicon and 390 target price reflects these positive outlooks. And finally, let's talk about the impact of falling crude oil prices on paint and tire stocks and end today's video. Crude oil prices have dropped over 3% after OPEC slashed its demand for. This decline has positively impacted paint and tire manufacturers, reducing their input cost and increasing profit margin. Asian paint shares are up by 1% at 3,085, while Berger Paints has gained more than 2.5%. Shalimar Paints has seen 1.3% gain. These gains are driven by reduced raw material costs, primarily crude-based input. Tire stocks have also benefited from crude prices. CATIs, Apollo, and Balakrishna Industries have traded with gains up to 1.5%. Lower crude prices reduced production cost for tire manufacturers as well. The paint industry relies heavily on crude-based raw materials, accounting for around 55 to 60% of their raw material cost. Falling crude prices reduces these costs, increasing profit margins for the company. Tire manufacturers also benefit from lower crude prices, as synthetic rubber and petrochemical are key components. Globally, crude oil prices have dropped due to OPEC's reduced forecast, along with geopolitical tensions regarding Israel and China's deflationary pressures and lack of clarity and economic stimulus. These factors have led to a decline in Brent crude oil futures by $2.11 to $75.35 per barrel. The investment thesis for paint and tire stocks is built on reduced raw material cost, increased profit margins, positive impact of falling crude oil price. However, there are also few potential negative impacts on oil drilling stocks like ONGC and Oil India due to the reduced profit margins. Friends, this is the end of today's video. If you at any stage find the content informative, don't forget to like our video and try to share our channel with your friends so it will encourage us to grow our channel. And I will come back again with another interesting video. Until then, have a great time.